I absolutely positively believe that in a nominal sense, the silver price at least triples. At least. When's that going to happen? I don't know. I have no way to know. Um, so I don't seek to know. I just know that when it moves, it really, really, really moves. I can psychologically and financially afford the risk to wait. And the volatility doesn't bother me at all. If it goes to 36, I'm not excited. If it falls to 33, I'm not depressed. Like we said at the beginning of the discussion, that's the difference between music and noise. You know, uh, those little moves are just noise. $100 silver, no, that's more like music.
Silver continues to face technical headwinds as it consolidates near the $36 level, encountering resistance at the critical $36-31 threshold. This consolidation phase reflects the market's cautious sentiment as investors weigh various economic factors and technical indicators that could influence the precious metal's near-term direction. Despite the current sideways price action, seasoned resource investing expert Rick Rule maintains an unwavering long-term perspective on silver's potential. Rick Rule says that he can psychologically and financially handle the wait to silver breakout. Short-term volatility doesn't concern him. If silver goes to $36, he's not excited. If it drops to $33, he's not upset. These small movements are just noise to him. $100 silver, that's more like music, Rule concludes, highlighting the difference between trivial price shifts and meaningful long-term gains. The technical outlook for silver suggests substantial upside potential over the medium term. Chart patterns and long-term trend analysis point to a projected price range of $88 to $100 per ounce between mid-2027 and mid-2028. This represents a significant appreciation from current levels and aligns with Rule's conviction that silver will at least triple in nominal terms over the coming years. Rule's confidence in silver's long-term trajectory stems from his understanding of the metal's unique market dynamics. While he readily admits uncertainty about timing, an honest acknowledgement that separates credible analysts from market prognosticators, he emphasizes silver's historical tendency for explosive moves. His observation that silver really moves when it does break out reflects the metal's characteristic volatility and the potential for substantial gains when conditions align. The fundamental backdrop supporting a bullish silver outlook extends beyond technical analysis. The outlook for 2025 appears particularly promising, with multiple analysts pointing to significant potential for silver price appreciation. The convergence of technical indicators, fundamental supply-demand dynamics, and macroeconomic factors suggests that patient investors may be rewarded as the precious metals complex enters a new phase of its long-term cycle. Before we get started, don't forget to like, share, and subscribe. Hit the bell icon so you never miss timely updates on gold, silver, and market trends.
Things I've really, truly learned is that while a lot of people get the strategy right, they say the price of gold has to go up and the price of silver has to go up more. And that could be a 3-year or 4-year or 5-year phenomenon. So they get the strategy right, but they get the tactics wrong. They're afraid to hold the asset class over a long weekend when they're taking on a 3 to 5 year strategy. They think that what they want matters. Okay, I got my silver position. Now it needs to go up by Thanksgiving. You think the silver market cares what you want? So people got to wrap their heads around this. I absolutely positively believe that in a nominal sense, the silver price at least triples. At least. When's that going to happen? I don't know. I have no way to know. So I don't seek to know. I just know that when it moves, it really, really, really moves. I can psychologically and financially afford the risk to wait. And the volatility doesn't bother me at all. If it goes to 36, I'm not excited. If it falls to 33, I'm not depressed. Like we said at the beginning of the discussion, that's the difference between music and noise. Those little moves are just noise. $100 silver, no, that's more like music. History, okay? The last time we had a period of rapidly declining U.S. dollar purchasing power was the 1970s. In the 1970s, the U.S. dollar lost 75% of its purchasing power, and gold ran 30-fold. 30-fold, okay? Now, I'm not suggesting the next 10 years that gold runs 30-fold, but I am suggesting in the next 10 years that gold loses 75% of its purchasing power again. And well, I don't know, and you've been interviewing me long enough to know I don't know. I suspect that the increase in the gold price will mirror the deterioration of the U.S. dollar, its purchasing power. That means that gold should rise threefold or fourfold. Let's say I'm wrong and it doubles. That's not a horrific outcome. And armed with that knowledge, which is to say at least the nominal price of gold rises for 10 years, That meets the definition of a gold bull market. And gold bull markets follow predictable patterns. In the early stages of a bull market, what moves is gold, not the gold stocks. When you first started interviewing me, you expressed your viewers' frustrations that gold was moving, but the gold stocks weren't. And the explanation I gave to you is, first of all, this is the way history works. But secondly, one asset class, gold, had a buyer, foreign central banks. And foreign central banks don't buy gold stocks. So if one asset class has a buyer and the other asset class doesn't, of course the one that has a buyer goes up. And that's what happened. Like earlier bull markets, the momentum established by gold eventually spills into the gold stocks. It does that for two reasons. The move in the gold price validates the narrative to investors. They get interested in gold as a topic. But the second thing that happens is as the gold price increases faster than the input cost to produce it, the companies make more money. And we've seen that just in the last 15, 16 weeks. We've seen solid inflows into gold ETFs, and the buying has been concentrated in the best of the best, the Wheaton Precious, guys like that. When that momentum establishes itself, courage and cash goes down the value chain. And that is what you saw in gold royalty, and that'll continue.
Veteran resource investor Rick Rule brings valuable historical perspective to current silver market dynamics. Drawing from his experience witnessing three major bull markets where gold achieved tenfold gains, Rule provides a seasoned outlook on precious metals cycles. While he stops short of predicting another tenfold increase, Rule believes that even if gold merely triples from current levels, silver's inherent characteristics could drive it to even more dramatic price appreciation. Gold has demonstrated remarkable strength throughout this year, propelled by a confluence of favorable factors including a weakening U.S. dollar, growing expectations of Federal Reserve rate cuts, and mounting recession fears stemming from global trade tensions and tariff implementations. Gold's performance is cyclical and driven by macro conditions. The early 2000s saw solid gains, but unlike the 1970s, not a tenfold rise. From 1982 to 2000, gold lagged due to high real rates and a strong dollar, despite a booming stock market, underscoring monetary policy's impact on precious metals. Silver's unique position within the precious metals complex stems from its characteristically higher volatility compared to gold. This enhanced price sensitivity means silver can experience wider price swings in both directions, creating the potential for more dramatic percentage gains during upward price movements. When precious metals enter sustained bull phases, silver's volatility often translates into amplified performance that can significantly outpace gold's gains. Let's get back to the video.
I came into the silver market in 1970 when it was $1.20 an ounce. At the end of the decade, it was $50 an ounce. When you see a silver bull market, silver is much more volatile than gold. I don't know why it is, but here's what I know about silver. A precious metals bull market is led by gold, and the price momentum is established by gold. And when the price momentum validates the narrative around precious metals for the generalist investor, not the precious metals investor, but the generalist investor, the Fidelity guy, the Vanguard guy, pardon me, when that guy comes into the market, for whatever reason, perhaps because of the lower unit costs that silver has relative to gold, they crowd into the silver space. And when they crowd into the silver space, traditionally, there hasn't been enough market cap in the silver silo to handle the money that comes in. And it doesn't go up, it explodes. By the way, you're not going to need Rick Rule to tell you when that happens. You're not anticipating a $35, $36, $37 move. The three times in my life, the gold price has escalated by 10 times or more. I'm not saying it's going to escalate. I'm not saying it's going to go to 300. But if I'm right about the gold price, which is to say that the gold price could go up 3 times from here, the silver price can do more than that. When it's going to happen, I don't know. And you know what? At age 72, I don't care. I'm going to see it with my faculties intact. I'm going to enjoy it. I'm not going to enjoy the reasons for it, but I'm going to enjoy the thing. So it'll take care of itself. I don't think of gold in isolation. I think it in juxtaposition to the U.S. dollar and the real U.S. dollar interest rate. The best way to answer that question, Daryl, is gold fully priced, is what set of circumstances would cause me to sell my gold? How would I identify it as overpriced? I own gold because I believe debt and deficits in the U.S. are out of control and will lead to the deterioration in purchasing power of the U.S. dollar. So what would cause me to sell my gold? The first would be a balanced federal budget. We're $2 trillion out of budget and getting worse. The second would be a sane fiscal plan for dealing with $100 trillion in net present value of entitlements. We're a long way from there. The third would be declining real interest rates. And that's tougher to explain. A real interest rate is the plurality of the 10-year Treasury yield to the underlying rate of inflation. And this is the subtle part. Right now, if you believe the CPI, you believe inflation is 2.5%. The US 10-year Treasury rate is 4.5%. So you're getting a 200 basis point real yield. But if you believe, like I, that the underlying rate of inflation is 7.5%, you're getting paid 4.5%, it means that you have a minus 3% real yield. So for me to sell my gold, I would have to have a 200 basis point real yield to underlying inflation, which is to say that the US 10-year Treasury rate today would have to be 9.5%. If that's true, the first mortgage rate would be like 11%. If you look at all of that arithmetic, but particularly the real interest rate differential, you see that from my point of view, the reasons for me to own gold are very much intact. I'm not expecting gold to increase in price in real terms in the next 10 years, although it might. It might be because of the human psychology you talked about. It might be because it might be that the increase in the gold price causes people to overvalue the narrative and they buy too much. But all I'm counting on is that the gold price will mirror in nominal terms the deterioration of the purchasing power of the US dollar. It will maintain its purchasing power today in a currency that declines by 75%.
Gold and silver continue to reflect broader economic realities, responding to monetary policy, inflation, and investor sentiment. While gold offers long-term stability against currency decline, silver carries the potential for explosive upside during bull markets. Together, both metals remain vital stores of value in an uncertain financial landscape. Are gold and silver still the best shields against a weakening dollar? Let us know your thoughts in the comments below. If you found this video helpful, don't forget to like, share, and subscribe. Thanks for watching.